Yes, starting up. Now we talk about finance. Yeah, the last time we talked about how to set up the startup, your problem and solution, a business plan, and so on. And I said the finance part we will do separately because there are, let's say, a couple of minutes to talk about. And this is certainly the specialty of all people coming from life science, which have not an MBA. And that's what we do now. So that's what we will talk about in the part finance. We will talk about the sales and costs, the income statement, a balance sheet, the cash flow forecasts, sales forecasts, and the net present value. So as a reminder, our principle, what we talk about is our campus bike project. We have already introduced that in the part starting up in the general part. So if you have not watched it, I recommend watch the other part first. And what we want to do is we want to sell or rent our bikes to students and professors. And as a starting point for our finance part, what we have already done is we have looked on the market and we have identified what is the market share we can access. And this is the starting point for all our calculations. Now, what we will do is we will do the following things in Excel, and I will show you directly in Excel how you can approach the finance part. This is certainly the section where the life science engineering guys and so on have their major problems. And also I realized that even if the students have heard business administration in the first or second semester, this is the first thing they completely forget. And honestly, they think, and this is not something which also something I am aware when I have studied, because they think you don't need it. But honestly, you need at least some information on that. And therefore, I want to briefly wrap up the finance stuff, that you have an idea also what you need to put in and how to do that. But of course, also, especially here, it's a wise idea. If you really go for a startup, contact someone to at least proofread your financial plan, that it's not a completely nightmare, because you will not get money even if your idea is brilliant. Again, this is the investment in the team. If a business investor sees or realizes that you have no idea at all of how to get money, or how to work with money, how to set up, let's say, a balance sheet, how to set up a cash flow analysis, and so on, then no way, you will not get the money. Okay, the first thing you want to start with is the sales section. And you have done your market analysis and you have analyzed what is your accessible market. So remember, I have just transferred it now to Excel. We have asked how many students are there, how many professors are there, what is the percentage of students and professors which are addressable at all, and what is our market share in the first year. And these are just the numbers copied into this table here. Now we also said from our survey, we know that the average learning period here of our students are 3 days, and the average learning period of a professor is 5 days. Then we have deduced our sales price. So the students are 8 euros and the professors are 20 euros. Now, of course, there are costs associated with that. And for your sales forecast, it's always good already to include the direct costs. We will talk about costs in a couple of seconds, one more time. But I would say then we put here now the direct costs, the repair cost, we say it's 10% of the sales, and the replacement costs is 5% of the sales. We come to the costs in a second more, and then we talk about that in more detail. So this is our basic assumptions. And well, then we can go and just put here for the unit sale forecast. This means that for a student, we have 8 euros the sales price, and the direct costs are 1.20 euro. It's just 15% here. So of course you do that in Excel or another spreadsheet software. And of course you use formulas, because what you want to see always is what happens if I reduce my sales price to €5. And of course then everything should change. Okay, the professors, we have the same. We have €20, and we have also here 10%, 5% the costs, and then we are at €7, which is our gross margin. How this is called, we will talk about in a second. Now this is per unit, and now we come per year, and again here we calculate in our market share. What we do is, if you click at that, you see it's just we multiply our student numbers with the addressable market, with the market share in the first year, and the days of the learning. That's it. And then we do the same with the professors. And of course, here we go for the number of professors, addressable market, and market share first year, and the learning period of the professors. And then we get a sales forecast of €1,800 for the students and €600 for the professors. Here we go, the costs and so on. So at the end, we have a gross margin of €2,040. So that's our sales forecast. And now, of course, I already said that we have costs, and I also said that we need to invest maybe in something. So we have to set up our investments, and we have to bring in our costs in order that we can start calculating our income statement. Okay, so costs, let's go to the investments. Now we say, okay, in this case, we go for we need bikes. Of course, we are a bike rental service. So let's start with 6 bikes. And we say the cost per bike is €300, which is quite cheap for a bike rental service. Of course, if we start up a company, we want to have a cool computer and not just our cheap stuff around. So we also plan to invest in a computer for €1,250. We need some office equipment, not too much, and we need some repair equipment. So this is not the materials, this is the equipment. The material costs are directly in this percentages. So these are our investment costs and in total. And now we come to the costs themselves. Now you see here what I do is I line up all my cost elements in rows. So I have my repair maintenance costs, substitute bikes, sales and marketing, and so on. So this is important. You should, first of all, for costing, the most important step is identify all your cost elements. So you might have cost elements in general also like salaries and rents in general, but we say no, in this case we don't have salary and rents because I start myself and I do that just in the garage. So I do the repair and so on in the garage, and I have talked to the president. I'm allowed to sell somehow the stuff on the university level. So that's no problem. I don't need to rent something for that. Of course, these are all things that if you really go out for a business, you have to see that you don't get in conflict with regulations and so on. This is something we don't care here. It's just that you have an idea of cost analysis and how to do that. Okay, so now, to be honest, this is true for everyone who just starts with a company. The costs are, you have not a real clue at the beginning what are the real costs about that. What you can do is look to similar companies, and usually what you can find out is what is the fraction of the cost for the sales price. So if you, for example, want to sell a food product, what are the costs for, let's say, production? What are the costs for distribution and so on? Of course, it's always better to have the euro cost. That if you know my raw material costs, whatever, if I produce sausage, that beef is 5 euros per kilogram for my production process. This is better. But if you don't get this data, just go to related products and look what is the percentage of the raw material price and apply that. So this is something which is often done at the beginning if you have not enough information, and this can give you a first overview. Always think of let's say, time is money. So not in all stages you should invest too much time. Costing, however, is a critical issue. So therefore, I will certainly make an additional video on showing you what you can take out with costing. And usually the typical error of a startup company at the beginning is that you underestimate your cost. This is the problem. Okay, now we have our repair maintenance costs. We have taken over these 10%. And now we say, okay, each year at the beginning, I say we have 6 bicycles we have bought, and it's quite sure that 2 of them will be really broken and we cannot use them anymore after 1 year, so we have to substitute them. Salaries, rents we don't have. Then we have our sales and marketing costs. We just say it's 10% of our sales, and administrative costs, it's 5% of our sales. That's okay at the beginning, as you are your boss yourself, so you don't get a salary, and then you can scale kind of your spendings for sales and marketing. So you just spend as much as you have at that point, and this is okay. And also your administrative costs usually are not an issue, because you have your computer and use it, and that's it. So you don't need tons of paper or whatsoever at the beginning. So this is just for start, this is fine. Now you see the categories differ. We have a DC and OC category. DC are the direct costs. So this is costs which are directly attributed to each unit being produced. So as soon as I rent out a bike for 1 day, there will be repair costs coming up. The more days I rent my bike, the more I have to substitute. So they are directly connected to the sales amount of sales. Other costs, salaries, rents, and so on, are constant. So they are overall costs. So they are attributed in a different way. This will be explained further in the cost analysis. This is just for you here to have that in mind. In German, for example, these are the things which contribute to the Deckungsbeitrag, so-called Deckungsbeitragsrechnung. This is important if you want to check your, for example, break-even point. This is also, we will see then in an extra video. Now, the point is, what is not there are our investment costs. So we had investments of, just summarizing. The sum is, I'm on the sum. So it's 5,000, around about 5,000 euro investment costs. Where are they? Of course, investment costs don't go directly in your calculation. They are going in via depreciation. In this case, we don't talk too much about depreciation, but of course, we have here our depreciation, and this is the cost which comes from the investment. So this has been calculated based on the investment cost. So this is our cost calculation. Of course, in reality, it's a longer list, but it's always the same. You first have to identify your cost elements. The advantage is if you do, for example, your project and work out your process with SuperPro Designer, for example, this will already give you the costs for your process. And to get these costs is the most difficult thing at the end. Then you can assume something for rent and marketing, everything is fine, but you have the major part of your costs you have already. Having the sales and having the costs, we can start doing an income statement. An income statement in German is the Gewinn- und Verlustrechnung. So what we do is we calculate how much we actually earned with this. So we have our revenue. So this is also just taken. So again, it's Excel. So if I change here, I say, we go with 15 euros per student. Then you see here my revenue sales are going up. So this is the reason why you do that in a spreadsheet software, of course. So Okay, so I have my 2,400 euros, and then I have our costs, and then I go here, for example, repair and maintenance costs, and I just put in the formula. So this was this about the sales price over here, and here we just take what we have put here as substitute bikes, and this is annual, so everything is fine. So we just put in, we just transfer the values from the other table. Of course, you could also do a smarter calculation, so you could then do a if function and so on, but it's not an Excel course, it's let's say basics here. But you see, this is why in financing Excel is or spreadsheet software is standard. So this is what everybody uses, because this is really, for this, it's really making life easier. Okay, now we go to the next cost category. So we have already said the direct cost. If we look at the direct cost, or also the cost of goods, so this is a notion. Cost of goods means this is kind of the raw materials which go in for the bikes. It's maybe a bit more indirect, but this is for if it's clearer. If you again produce your sausage, your beef and your salt and so on, which are directly the raw material, are directly cost of goods and directly associated with that. And then we have our gross margin, which is this value here. Now, we want to come up with a real income statement. And of course, we need to sum up all the costs here. And so we have to put in the remaining costs. And for example, we have here the operating expenses, sales and marketing administration. So again, we do the same. We have defined them in our cost sheet, and they're percentages of the sales. And this is just then going in here. So again, this link to the spreadsheet is down there. So you can then go and fiddle around in this spreadsheet yourself. Now, this is if you take out the gross margin, if you subtract the direct costs and the operation expense, you come up with a so-called operating income, or the EBITDA. So this is earnings before interest, taxes, depreciation, and amortization. So this is not the complete earning, but this is a value which you might read from time to time. In Germany, this is unusual that an EBITDA is calculated. If you go on a foreign, if a startup in the Anglo-Saxon, let's say, if you want to make a spin-off in the States or in Britain, you're expected to have that. If you go in Germany, it's unlikely that you state an EBITDA. When we look at the cash flow, the advantage of an EBITDA is that it's kind of related to the cash flow. So this is maybe some advantage. So then we have the depreciation, amortization costs, which are subtracted, and we come to the EBIT, which is then the earnings before interest and taxes. Now, our company, we say, yeah, the money is from our parents. So therefore, the good news is we don't pay interest. And then the revenues are so small. So in Germany, for such a company, you will not yet pay taxes. So the interest and taxes are zero in this case. And then we come up with our net profit, and that's everywhere the same. This is our given. This is 583 euros in this case. It's also called EAT. So it's earning after taxes. And this is our net profit. Okay, so this is our income statement. This is what we actually earn. So it's at the end, revenues minus costs, full stop. And you just sort the costs according to the cost types in an income statement. Of course, you will have more costs, different costs, and so on. It doesn't matter. Just look where your costs fall in, whether they are direct costs, whether they are operating expenses, and the depreciation come extra, and that's it. So it's not really an art. It's kind of straightforward. This is the income statement. And the next thing you're usually requested to do is you need to get in a balance sheet. Now, what is a balance sheet? A balance sheet is at the end document listing your assets versus your capital. So where is your money in your company and where did the money come from? That's a balance sheet. So these are our assets. So in the income statement, our investments, you remember, just go in by the depreciation. In our balance sheets, we have the real values inside. So at the beginning, when we have new bicycles, new computers, and so on, we had 6 bicycles, 1 computer, and so on. So it's the values of the assets which are in. On our bank account, we still have nothing. So there is also an order and so on. So of course, you can have courses in setting up a balance sheet. This is very simplified. And for you, the students in my classes, I don't care about the order. If you have the correct order, everything's fine. So the order, by the way, here is that you start from assets which are hard to get the money out. For example, if you have buildings, selling a building is not so fast. And of course, on your bank account or cash, you can directly take the money. So this is liquid. So the liquidity goes up in this direction. Now, you have to, as I said, on the other side, you need to have the capital. And in other words, at that point, it's zero. But it can't be zero because if you have bikes, computers, office equipment, and so on, you had to pay all that. So you will not get bikes if you don't pay. So the money had to come from somewhere. Now, if it's the bank and you have a loan for that, it would be liability. That's okay. Then, of course, you will also have to pay interest. But we say it's our mother who paid us because she trusts in us, who gave us the money to put in there. So she gave us 5,050 euro that we could buy everything. And now this is the owner's equity. So this is our money, which is inside of the company. Okay, this is a balance sheet, and a balance sheet needs to be balanced. Full stop. Otherwise, it doesn't work. Now, then the operations during the week, it's bookkeeping, accounting, and so on. This is a completely different story, but this is not something you really need when you start with a startup. It doesn't really matter. Of course, if you then are in operations with your company, you need to know something about bookkeeping, or you need to have someone who takes care about you. Usually, you are then there will be a company who will take care of that. If you're small, you don't do that yourself. But a balance sheet, setting up the balance sheet, you need to know how to do that at the beginning. And of course, if you're a larger company, if you want to start up a larger company with more elements and so on, it's clear that an investor will have a closer look whether the balance sheet is appropriate. Otherwise, it's an indication that you have no idea of what you're doing. And therefore, you should ask someone who is has a knowledge of financing and accounting to set up the balance sheet correctly. Okay, this is the balance sheet. And if you look at our income statement, everything is fine because we have earned 580 euros. Everything is fine. So this income statement doesn't appear on the balance sheet. If we have a yearly production, you know that then is the difference of the owner's equity and so on is your profit. But we don't care at that point. Yeah, we care that our income statement tells us that we made 580 euros profit. By the way, if you then take this profit in your pocket, of course you will have to pay taxes. So it's not that the company doesn't have to pay taxes, but you will have to pay taxes. Don't forget that. Yeah. So now this means that's cool, our company makes money, but this is then the start of the cash flow analysis. Because if you just look at this income statement, it could be that you don't need money at all if you just look at that, because you earn more money than you have costs. Therefore, why should you go to a bank to ask? We had already a glimpse of an idea about our balance sheet, and this is in the cash flow analysis, we really see what money we need. There are different methods to set up the cash flow. Again, this is not a course in business administration, financing, accounting. We just look at the direct method. At the end, what cash flow is about. So if I do it today you rent the bike and you pay it next year, then the cash flows next year, but the profit is made this year. So that's the difference. Or if I buy my computer and pay it next year, the cash flow is next year, and the inventorized computer is going in this year. So cash and profit is not always the same. This even more, the computer is not going fully in the costs. It's just the depreciation which goes into the cost. However, I have to pay it now. So usually if you're just starting, or if you're a student and want to buy something at Amazon, you have to pay in advance. Otherwise, Amazon will not send it to you. So the cash is gone, your computer is there, but the depreciation is over a couple of years. So it's not at the very beginning, but you have to pay it. So what you do in a cash flow analysis, you follow the real, as the name says, the real cash flow. So when is something being paid, or when do you get the money for something? Now, let's assume that revenue sales, we also have our students, let them pay in advance so that we are sure that we have the money. So here everything is fine. And for the expenses also, we say we pay that directly. Everything is fine. So we have our cost of goods, substitute by operating expense. This is really the money which is going out. Now, capital costs we don't have. Again, we have borrowed the money of our mother, and she is therefore, of course, participating in the company. She could tell us, I give you money. If it would be a real investor, this investor will say, okay, but now I owe 20% of your company. So all the profits and so on, 20% of the profits, for example, go to this investor. This is, of course, something he or she can say. Now, in contrast to the income statement, now we have also the investments going into the cash flow. And you see here we have the bikes, computer, and so on. And you see the cash flow in the first year is dramatically negative. So the cash flow tells you, oops, you need money. With a negative cash flow, it's not possible. You need to bring up the money from somewhere. And this money could come from your mother, or it could come from an investor, but you need money. So this is what the cash flow analysis shows you. This you don't see in an income statement. What we have done now is we have looked at statements which are just for the first year. How, of course, but the first year you see it's not quite attractive because our sales are quite low. We need to invest everything. So everything looks negative. So it's clear that it might be wise to make a projection. If you start up a company, even it's you remember you have to pay the bicycles at the very beginning. So it's not 3,000. Your cash flow seems to be, if you look at that, that you need 4,000 euro, but instead you need this amount of money, this 5,000 euro at the very beginning, because you buy everything at the beginning where you don't have revenues yet. So what you do usually is, if you set up your company, you make even a monthly cash flow analysis to see when you need what as cash. And then you do it really over 5 years. That's quite common. So what we do here is we will just look at a yearly projection. So we start with year 1 to year 5. And that's, of course, also if you do it in my projects, that's fine if you have a 5 years projection. So you want to see how are your earnings developing? And is there the investor want to see what is the fantasy in your case? So hopefully in 5 years you can address more students than at the very beginning. That's your intention. And this needs to be reflected then in your projection. So here we go. Let's go to the sales. And this is again our initial assumptions we have already made. And we have said that at the beginning, our addressable market is, we have 10% of the market share addressable for the students and 20% for the professors. Yeah, and now we could think of what is a potential trajectory. So it should rise. So we want to develop our company. We invest in sales and marketing. So what we could say is that the students there are a lot of students, so at the beginning it might be a bit difficult, but as soon as we reach a certain threshold, we can rapidly go up. So for example, in the second year, we can reach just 20% of the students, so we have doubled it, but then the knowledge has risen and we're at 50%, and year 4 and year 5, we are at 100%. And of course, you do it in an Excel sheet. So in this case, that you can calculate the sales directly, and the direct costs, you remember, are, we used here the percentages. Of course, you can make this more sophisticated and so on, but it's just a demonstration here. Now, the same for the professors. We have a bit more because you know a couple of professors directly and therefore you have talked to them. But then the professors are more conservative, so the rise here is slower. So we assume that we go up to 50% after 5 years here. So it takes really long to convince all of the addressable market in the case of the professors. So this is then our sales projection. And of course, our direct costs go directly in parallel with sales because they are direct costs by definition. Now what we do is, based on the sales projection, we go and look at the cash flow analysis here. So what we do is the same. We have then just transferred the revenue sales from this chart. And now what we do is the cost of goods. This is again direct cost. So this cost of goods is coming from this one. But what we say, the substitute bikes, what you could do is you could say, okay, our life expectancy of a bicycle might be 150 days. So what we could do is we can say, okay, so after the first year, based on the life expectancy, we will have to substitute the bike. So you see, this is our days of use. So this is also coming from our sales here. This is just adding up these days here. And now I have used that 255 days. So this means I need to buy 2 more bikes. So what I do is I just put in a formula here, and that's the German expression aufrunden. So it's rounding to the next higher integer. And then I just divide this number by this number. And I have defined it as bike life. This makes life easier. So I have named it as bike life, and then I round it to 1 full integer. And I have 1 full integer, and then I multiply it, of course, with the costs per bike. So I go to costs, and I go to investment, sorry. And 1 bike is 300 euro. So this means I will have to pay 600 euros at the first year. And then I should, of course, not forget to put my dollars here. And you see that in the following years, my cost will go up. Okay, so this is an example. I have refined that a bit and calculated it really based on the bikes. The operation expenses are already directly a percentage of the revenue sales. Again, the capital we don't have, and these are investments costs. Now, of course, it's clear that we started with 6 bicycles, but if you see that here we have to 4,800 euro or 1,200 euros, 300 euros each are still 4 bikes, but 2,400 euros, it's unlikely that we get these 2,000 days in use just with 6 bicycles. So we need to invest in between in more bicycles. So what we can do is we say, okay, we start with 6. These are just the bikes we substitute. So these are the new bikes. We still have 6 bikes around, but now we buy 8 new bikes in order that we can create, deliver, or have more customers. And here we then say 15. And now you see that here not much is changing. Then we are happy. So we have, at the end, we end up with 29 bikes. We have 4 rent, which is quite a bit. So this, you see that the costs of this investment go up, cash flow. And then with the computers, the point is after 3 years, usually the computer is broken. So this means after 3 years, we will have to buy another computer. And for this equipment cost, usually you say this lasts for 10 years. However, we say, let's say every second year, we might need to buy, invest 1/5 of the cost and for the next computer, for the next office equipment, and the same is for the repair equipment. Okay, and every 2 years again here. So this is just also, of course, going in our cash flow. So this is just a possibility how you set up your cash flows over the first 5 years. You see again, the first year, this is what we already had. This doesn't look different. So our cash flow is negative, but you see this is adopted to our bike rental. Of course, for your company, you will set up the cash flow sheet in a different way. And it's for if you set up a production, it's unlikely that you scale your production after 5 years. There you have to start already with a production scaled for your needs after some years, but you scale, for example, the number of employees and so on. So your salaries will be scaled and so on. So that's what you might need to do in this case. Okay, so you see that the cash flow is negative at the very beginning, the first year, as we said, but at the end, we have a quite substantial cash flow. Now the question is, what does it tell us? So negative cash flow, of course, just means, you remember my mother has invested 5,050 euro. At the end of the first year, the cash flow was negative. So there is, of course, some money still in the company, but you would say, this is maybe not the ideal thing. So what you want to do with your money is you want to generate with your money a positive investment. So you want to know whether this investment in this company is worth it. Because usually as soon as you have brought in money into your company, it's difficult to get it out. I don't talk about exit strategies here because, of course, this is, of course, an important point that your investor wants to know how he's getting, or he or she is getting out after 5 years, for example, to get his or her money back. Usually then you go to the stock exchange and make an IPO, and then you get your money. But this is something else. So this is a classical investment where you want to keep your money in the company and where you want to earn something with your money. So the question is it worth to invest? And there are different ways to calculate it. Here we talk about investments which go over several time. And if you think of investments like investments in a truck developing company, where the truck takes 10 years to come onto the market, then time is an issue. And therefore, what I want to show you how to calculate is using the net present value, in German, the Barwert-Methode. And this is the most, for timed money streams, this is the most straightforward thing. The cool thing is it's just a cash flow based method, nothing else. So we go with this cash flow and just list the revenue, sales, and so on. So I could say, okay, this is the cash flow which really comes out of the company. So it's not the cost, it's the cash which the company has generated. So at the end, I could pick out this cash of the company, because this is really the money which is at the end on your bank account. Before taxes, to be honest, so you have to pay you have to consider your own taxes, that is, you shouldn't forget. So you could say, okay, I just sum up the money. So I have invested at the beginning 5,000 euros. So these are my investments here, but I can say, what is my, let's say, net present value of this money I have invested. So if I just would sum it up, I would say this is cool. You see it here. We are at 18,000 euros. That sounds cool. That sounds to be a smart investment. So the money I've put in overall is 14,000 euros. So this looks positive. However, if I'm investing now 5,000 euro and get out in 5 years, 9,000 euro. This sounds good. But then I could say, isn't it smarter to put it on a, let's say, on a let's say, stock options where I can expect to have a 5% interest rate or 6% interest rate without any risk, is it smart to invest in the startup company? Because of course, whether this is really coming out in 5 years, you don't know. So what you do is you put in an interest rate of, for example, 7%, and then you discount your cash flow. So what I do now, and this is something I might explain in another video. So what I do now is I just discount the cash flow. The first year, it's the same. And then I discount it with this interest rate back to the first year. And of course, the longer far away the investment is, the lower the cash flow. If I have here 10 years, you see, then it's half of the investment. And of course, it depends on my interest rate. So I don't want to go into the details here, but it's just a discounting back. You can analyze the details in your sheet. So but at the end, the important thing is just discounting back the cash flow. The far away, the higher discount rate, and this is simply the formula. So if I now sum up this discounted cash flow, then I come up with a sum which is called the net present value. So this means that the value stream of this plus this taken together, what is the actual value of this investment today? So you discount it back to the state today. So this means that I have a positive net present value, and as soon as it's positive, it means that this is an investment which is worth it. If you have an alternative investment where you could get an interest rate of 50%, then the net present value would be negative. The other investment would be more attractive. And of course, you see here that this is very attractive, but again, I already told you, usually the cost part is underestimated. This is the problem. Yeah, you're finance experts now. Maybe you don't feel like it, but you are. So maybe the one or other things, it's wise to have a look on another video or another tutorial. I have already said that I will do another video on costing and maybe also on other things like NPV. However, basically at the end, you need to have an idea of what's it about in order that you can put it in your finance section. And it's of course always wise to let it check by someone who is an expert of the field. So thanks for your attention. Good luck and goodbye.